Welcome to vTalkInsight, Risk Sentiment Daily for February 4th, 2026. Global markets are navigating a sharp rotation beneath choppy headline indices as strong earnings and AI-driven growth collide with higher yields, volatile commodities, and pockets of consumer strain. Let's unpack how that mix is shaping today's risk landscape. Risk sentiment today is two-way and rotational rather than outright risk-off. The S&P 500 has slipped close to 1% with volatility edging up toward 18, yet most underlying stocks are actually higher, pointing to rotation away from crowded big tech rather than a broad de-risking. Financials, cyclicals, and international exposures are quietly absorbing capital even as index levels soften. Outside the U.S., the tone is more clearly constructive. Asian equities have surged, with the regional benchmark up around 3% and major hardware names such as Samsung delivering double-digit gains. European indices are printing fresh record highs, led by industrials, basic resources, and technology, while rebounding precious metals, stronger copper, and recovering silver all signal renewed demand for real assets. Balancing that, cross-asset volatility is picking up. Long-dated yields are pushing higher, metals and crypto have seen sharp swings, and delays in key U.S. data releases are adding to uncertainty just as investors question the reliability of recent labor statistics. Compared with earlier this week, when the metals sell-off and AI jitters dominated, today looks more like a rotation phase, with investors keeping risk exposure in place but leaning harder on diversification, regional shifts, and name selection rather than simple index beta. Robust earnings and broader equity leadership are a key pillar supporting risk appetite. In the U.S., S&P 500 companies are again beating expectations at a high clip, with upside surprises echoing prior seasons and reinforcing a double-digit growth trajectory into 2026. European corporates tell a similar story, where strong results in sectors like industrials, basic resources, and technology are propelling regional indices to new highs. Crucially, that earnings strength is no longer confined to a handful of megacap AI names. Leadership is rotating towards cyclicals such as industrials, energy, and materials, and mid-cap U.S. equities are highlighted for stronger earnings profiles and lower leverage compared with smaller companies. Asian hardware names and selected financials are also contributing, pointing to a healthier, more diversified growth mix than the narrow megacap dominance that worried investors last year. At the same time, investors are becoming far more discriminating. Within AI and software, small misses on growth or spending plans are punished, as seen in sharp moves around names like PayPal and parts of the software complex, while genuine earnings beats in areas such as chips or selected consumer franchises still attract capital. With valuations already rich, this combination of strong but uneven earnings and greater dispersion supports the idea that broad equity exposure can still work, but only if investors respect guidance risk and the market's low tolerance for disappointment. AI-driven investment and emerging productivity gains remain a powerful medium-term tailwind. Large technology and platform companies are in the midst of a historic capital expenditure cycle, with hyperscalers expected to invest hundreds of billions of dollars in data centers, GPUs, and networking infrastructure. AI-related spending is estimated to account for roughly a quarter to two-fifths of recent U.S. GDP growth, a meaningful contribution even if some of the more extreme estimates prove exaggerated. This investment wave is radiating across sectors. Memory chipmakers enjoy strong pricing power as AI demand outstrips supply, while rising electricity needs from data centers are drawing capital into renewables, driving more mergers and acquisitions in the power and grid space. Companies like Palantir are posting rapid commercial revenue growth and upgrading multi-year outlooks, and concepts such as orbital data centers tied to entities like SpaceX and xAI hint at new infrastructure layers that could emerge over the next several years. On the macro side, U.S. productivity is showing signs of improving several years into the recovery, reminiscent of past periods when technology adoption underpinned sustained growth. Many AI investments are being funded from operating cash flow at highly profitable firms, which limits systemic credit risk even as leverage edges higher in specific cases. That said, credit markets are already scrutinizing leveraged AI spenders such as Oracle, and concerns about potential malinvestment mean investors will likely reward projects that can clearly demonstrate returns while penalizing those that cannot. Emerging market and commodity-linked risk appetite is another important support for global sentiment. After years of outflows, emerging market debt is attracting renewed interest, with more than $6 billion in inflows year-to-date and record demand for EM bond exchange-traded funds. Investors are being drawn by attractive real yields and favorable yield to volatility characteristics across both local currency and hard currency exposures. In commodities, price action also reflects a willingness to embrace risk. Copper is up around 4% on signs of Chinese stockpiling, lifting mining stocks and basic resources indices, particularly in Europe. Gold and silver have rebounded sharply from recent declines, with gold up several percent and silver posting double-digit gains, while underlying demand from central bank diversification and dollar hedging continues to provide a structural bid for the yellow metal. These flows are not without risk. Silver, for example, typically moves 2 to 2.5 times as much as gold during trend shifts, making it prone to violent reversals, and the metals complex only just recovered from one of its steepest 2-day drawdowns in decades. Even so, the renewed interest in EM debt and commodity producers signals that many investors still see the global growth backdrop as supportive enough to venture beyond core assets, provided they respect the higher volatility that comes with it. On the bearish side, rising long-end yields and rate risk are emerging as the dominant macro headwind. U.S. Treasury yields are pushing higher across the curve, with the 10-year moving above 4.28% and the 30-year approaching just under 4.92%, while stronger manufacturing data has lifted short-end rates as well. At the same time, global bond issuance has already topped $1 trillion this year, adding supply pressure and feeding volatility across rates, currencies, and metals. Policy dynamics are amplifying this concern. Australia's central bank has become the first major economy to hike in 2026, and markets now fully price at least one more increase there, underscoring that inflation is not yet fully tamed. In the U.S., debates over potential Fed leadership changes, the pace of balance sheet reduction, and the prospect of yield curve control leave investors guessing about the longer-term anchor for rates, even as credit spreads sit at their tightest level since 1997, a classic late-cycle signal. Market participants increasingly flag a renewed rise in long-dated U.S. yields as the single most important threat to otherwise stable equity markets. Higher real yields directly challenge elevated equity and private market valuations, particularly for long-duration assets such as growth stocks, leveraged AI plays, and housing-related exposures. Robust demand at recent Treasury auctions offers some comfort, but if long-end yields lurch higher from here, it could force a broader de-risking across equities and credit, even without a deterioration in earnings. A second major headwind is stretched AI valuations and the resulting tech drawdown. Software and SaaS stocks are under heavy pressure, with the main software index now down more than a quarter from its 52-week high, as investors reassess business models in the face of rapid AI-driven disruption. Recent product launches, including new AI tools for legal and data analytics work, have triggered sharp declines in both SaaS and financial data providers on fears of cannibalization. Even where headline numbers look strong, expectations are unforgiving. AMD delivered a sizable beat on revenue and earnings and guided above consensus, yet its shares fell around 5% as the market concluded it had not closed the competitive gap with NVIDIA and flagged a near-term pause in data center growth. Elsewhere, companies like PayPal and Novo Nordisk have seen double-digit share price declines on disappointing outlooks, illustrating how quickly sentiment can turn when lofty expectations meet imperfect guidance. Underneath, concerns are building about how this AI and tech cycle is being financed. Major platforms are increasingly funding AI infrastructure with debt rather than free cash flow, raising questions about balance sheet resilience if growth slows, while the rising share of hyperscaler debt in investment-grade indices may be masking a deterioration in overall credit quality. With sustained U.S. equity gains seen as heavily dependent on large-cap tech and AI sectors that now represent more than half of the S&P 500, further drawdowns here have clear potential to drag headline indices lower even if other segments continue to perform. The third key risk lies in consumer and labor softness undermining confidence. U.S. consumer confidence has fallen steadily to its weakest level since 2014, with worries about jobs, affordability, and income growth now echoing post-crisis pessimism. At the same time, real disposable personal income has been flat since the third quarter, credit card balances are rising, and elevated energy bills, particularly in the Northeast, are squeezing household budgets. Headline employment still looks respectable, but the underlying picture is more fragile. Private sector job growth excluding healthcare has turned negative, a pattern usually associated with periods close to recessions, and the labor market is described as mediocre, with limited job-finding prospects for the unemployed. On top of that, revisions to payrolls data, especially changes to the birth-death model, could knock reported job gains down by 60 to 70,000 a month over the past year and a half, casting doubt on how strong the labor market really was. Data delays from a U.S. government shutdown and growing skepticism about the quality of official statistics compound the uncertainty, just as midterm election campaigning and policy interventions in sectors such as housing and credit cards raise the stakes for households. Against that, above potential U.S. growth, sizable tax rebates, and AI-driven capital spending are still cushioning the economy, and improving productivity offers a more optimistic long-term path. The result is a wide scenario range, from a soft landing with better efficiency to a more abrupt slowdown if consumer stress and labor market revisions eventually filter through to spending and credit quality. Stepping back, today's risk landscape is finely balanced. Broad earnings strength, AI-driven investment, and renewed appetite for emerging markets and commodities are keeping risk assets engaged, even as higher long-end yields, stretched tech valuations, and weakening consumer sentiment flash late-cycle warning signs. In the near term, watch the behavior of long-dated treasuries, upcoming AI and megacap earnings, and high-frequency consumer indicators, alongside flows into EM debt and cyclical sectors, for clues on whether rotation can continue without tipping into a deeper de-risking. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.